Welcome to Money Answers TV. I'm your host, Jordan Goodman of MoneyAnswers.com. Today we're going to find out more about the ARC Loan Mortgage Management System. My guest is Joseph Kelly. He's the president of ARC Loan, home of the automatic rate cut loan. Joe, welcome to Money Answers TV.
Jordan, it's great to be here.
Joe, Americans owe trillions of dollars in mortgages. So what are some of the problems these days with the way people obtain their mortgages and manage their mortgages once they have them?
Jordan, I think some of the biggest problems that I see in the mortgage industry when people are looking for a mortgage is that they don't take a little bit of extra time to research and find an ethical, trustworthy, experienced mortgage professional who's going to work with them, not just in the near term, but over the long term, to take advantage of interest rate cycles and other opportunities that those people can use to increase their savings and reduce their debt. The second biggest problem is that people are too quick to give information online to companies that really are not in the business of actually doing the loans, but they're taking that information and selling it to multiple mortgage companies. And then those people are barraged for weeks with calls and emails from multiple lenders, and it gets very confusing. Read the fine print. Look at the bottom of that webpage and see if those people are lead generators or selling or sharing information. We never sell anybody's information.
So Joe, explain how this works. So say somebody's got a mortgage at 4.5% and general rates drop to 4%. What's the process of taking advantage of that?
Actually, Jordan, the process is very simple. We live with interest rates on a daily business. That's the business that we're in. Most people don't follow that. So we watch for opportunities for all of our loan customers to be able to lower their rate for little to no costs whenever that opportunity exists. It could be from them improving their credit scores or values increasing, as well as when interest rates drop.
So Joe, what's the minimum amount that interest rates have to drop for somebody to consider doing a refinance with ARC Loan?
Great question, Jordan. There are many factors that go into when somebody might consider refinancing. I'd say all things being equal, if interest rates drop as little as 0.25%, and if they can do that for as little to no closing costs, it's actually worth them taking the time to take a look at that. But there's other factors that it might be to consolidate debt, to pay off a second trust, to be able to get out of mortgage insurance because they had that, or maybe their credit score is improved and now they can improve their rate by having a better credit score.
What are the financial criteria that you request of borrowers for them to qualify for an ARC Loan?
So there's no additional requirements to use the ARC Loan Mortgage Management Program. We overlay all traditional types of mortgages, conventional, FHA, VA, USDA. So the documentation that we require are the same that they would need to provide for any of those type of mortgage products from any lender.
Is there a minimum credit score? What kind of financial strength do they have to show to qualify?
So again, with any mortgage in today's mortgage market, there are some minimum credit scores, and they vary depending on the type of loan that they're looking for, how much they might be putting down, or how much equity they may have in their property.
So based on the value of your home, what's the maximum percentage you're going to lend out against the value of that home?
So for a purchase, you can go as high as 100% of the value for a VA loan if you have VA benefits, or a USDA loan if you're eligible for that. And for a refinance, again, you can go as high as 100% for VA or 95% for conventional, and you can take cash out. So it varies on the program.
So why would somebody take advantage of the ARC Loan compared to what a home builder might offer if you're getting a new home in a housing development of some kind?
When people buy a new home, oftentimes they are urged and sometimes make me feel forced to use a lender that the builder is recommending. Otherwise, they might be putting at risk some credits that they're getting from the builder. We actually can use the ARC Loan strategies to work with those people and show them how they can use the lender that the builder is referring to use our strategies to be able to help pay for those closing costs with the credits that they're getting from the builder. And then shortly after they close on that home, we can look to refinance them fully into the ARC Loan program and lower their rates further for little to no cost.
When people are shopping for a mortgage in the first place, some people say they need to be pre-approved, or some people say pre-qualified. There's a lot of confusion about this. What is really necessary to make sure they're going to get the mortgage in an efficient way?
Jordan, I think this is one of the most important parts for anybody, especially in this current market that we see now, for people to understand the difference between pre-qualification and pre-approval. And you're right, they throw around these different terms, so I'll break them down. Pre-qualification basically means you tell me how much you're making and what your debts are, and I'm taking your word for it, and I'm telling you what you would qualify based on your word. You're not providing me any documentation, not sending any pay stubs, bank statements, etc. A pre-approval is where you actually complete an application either online or in person or over the phone with a loan officer, and you provide that documentation. And most lenders then will run that through automated underwriting. That's what they call it, DU or LP, Fannie Mae and Freddie Mac, and tell you whether you're approved. We go one step further, and very few lenders offer this, and that's something called a true pre-approval, or a TBD, meaning that you haven't found a property, but you want to get a loan commitment. And that's where you provide your documentation. We actually give that to our processor, who then looks at that information, verifies it, submits it to our underwriter, and we give a full loan commitment that then you're almost as strong as a cash buyer when you go out and shop for a new home.
So what's the advantage of going through that whole pre-approval process in today's market, where in many cases it's hard to get a home because other people are bidding on it?
That's why it's so important, Jordan, because when you are already pre-approved and that stressful part of getting a mortgage is already done, the seller's going to be more inclined to take your offer versus somebody who has not gone through that process. The realtors are going to be much more inclined to work with you because they know that you're qualified to buy that house and be able to present that offer to the seller.
What fees and closing costs should people expect to pay if they're getting a mortgage through ARC Loan?
So with ARC Loan, there's no additional fees or closing costs for the program. Our closing costs, we work with national lenders and national title companies to offer some of the lowest closing costs in the industry. Our particular lender that we work with offers only one lender fee, and that is $1,195. We don't charge a 1% loan origination fee, and that covers the underwriting, the closing, and oftentimes we're giving a lender credit to pay for that fee. So we're among the lowest in the industry from a closing cost standpoint.
So you're saying the lowest. Give me an example of how other people are charging higher fees than what you are.
So fortunately, since the mortgage collapse, there have been a lot of laws and regulations put in place to help prevent the unreputable lenders from doing what they used to do and charging tons of closing costs. Although we do still see on a regular basis lenders who will have added fees. We don't do that. It's a very competitive market, and everybody should compare closing costs and rates whenever they're looking to whether purchase or refinance a loan. They should compare.
So when people are looking at closing costs, they can either pay them out of pocket or roll them into the loan. What are the pros and cons, and how do you help people make that decision?
Again, a good question, Jordan. So on a purchase, there's three entities that can pay for those closing costs, and there's always going to be closing costs. The buyer, the person borrowing the loan, can pay for those closing costs. The seller can pay for those closing costs, and we, the lender, can give a credit to pay those closing costs, and it can be a blend of the three. With ARC Loan, we have strategies to help educate people to look at what is most beneficial from both a near-term and a long-term standpoint for that borrower. On a refinance, the options are either you pay them out of your pocket, you wrap into the loan, or we, the lender, can give you a closing cost credit to pay for those. And again, we take the time to look and weigh the pros and cons of what's most beneficial for our borrowers.
So just give me an example. What would be the pro and con of having a closing cost rolled into the loan versus paying for it out of pocket?
So really the only time in an interest rate cycle that it makes sense to buy down the rate by paying closing costs and wrapping that in the loan is when it's at the very bottom end of the cycle, because you're never going to have the chance to lower the rate again. That's what we saw several years ago when interest rates were the lowest in 40 or 50 years. The ARC Loan Mortgage Management Program, the goal is to get you down to that lowest point without ever paying any closing costs. Because if you wrap those closing costs in, you're paying interest on those closing costs. Then when rates drop further, for you to refinance again, you've got to pay those same closing costs again. We show you strategies to eliminate that.
So this can get kind of complicated. How do you help people figure out whether it's better to roll the closing costs into the loan or to pay them out of pocket?
We do it the old-fashioned way. We talk to our borrowers. Today's world is very technology-oriented, people doing online applications and rocket mortgage and all these wonderful types of things. Most of the time you're talking to somebody in a call center when you're doing that. We only employ seasoned mortgage professionals who know the products, who know the ARC Loan strategies, who can look at where we're at in an interest rate cycle and offer different options of who's going to pay for closing costs, whether you should pay for them yourself or let the lender pay for them or suggest the seller to them. We go the extra mile and look both near term and long term.
So how do you continue to work with your borrowers after they've gone through the loan over several years?
Jordan, we look at every person who comes to us, not from a one-time sale perspective, but from a long-term relationship perspective. We have many of our employees have been with us over 10 years and have built relationships with our customers that continue to look for what we can do, whether it be changes in the interest rate environment or programs or strategies that will further help them to increase their savings and reduce their debt.
So if someone wants to find out more about the ARC Loan mortgage management system, how can they contact you?
Jordan, they can visit us at www.arcloan.com, or they can call us at 1-800-272-5626.
It was very interesting. Thank you very much, Joe.
Thank you, Jordan.
So when you need a mortgage, either for purchasing a new home or refinancing, or you want to save money when rates go down, visit arcloan.com. For Money Answers TV, I'm Jordan Goodman.